A sustained long-term downtrend with plenty of selling volume and consistent rows of lower closes begins to slow down into a flat range from approximately 13 to 1350. The current upswing stems from what can be called a triple bottom with a defined range from 3 minor upswing points. It also presents a decline most noticeable at the upper boundary of the range to have some similarities to a descending triangle. In any case, whether it is a failed descending triangle or a successful triple bottom, the upswing is weak due to overall low bullish volume. The small gap up shows immediate weakness as the last 3 candles are bearish to neutral. 1395 from the highest downswing in the triple bottom range is quite precise in providing firm support for the minor gap up, though it is likely to be breached given the return of strong bearish sentiment approaching the end of May, with drastically higher volume and a strong close lower on May 23rd. 1395 and the area slightly below it halt the expected bearish return due to supporting influence from the minor gap fill in early May and the upper range of the triple bottom. Eventually, 3 methods falling and 3 black crows price action is clearly visible into June to easily take GE back to the mid to upper 12 range. Now this becomes a key support in the short, medium, and long term. In the process, this is revealed to be a failed inverse head and shoulders, which is normally a more difficult pattern to spot. It was also complicated by the triple bottom / failed descending triangle and gap fill, which could have directed attention too much to the short term. The neckline range was also wider, but overall this was a near perfect example of a failed inverse head and shoulders. A very clear and symmetrical outline with increased volume to finish lower. A clear set of downtrend lines are established during very neat trading in the lower ranges, with the late June gap fill. Given the long-term context, coupled with an overall bearish 2018, another bearish continuation is likely upon decisively closing under 1273. The inverse head and shoulders did have a fairly wide neckline range, but it was mostly concentrated around the 15 level. Like other patterns, there was also flatter price action into the start of the pattern in January and February. It is similar to how price can trade flat for a time before and during the start of a double bottom or a triple top. The clear lower 1289 to 1273 boundary is from the lowest closing and low prices from the first upswing in late March that began the triple bottom. It could be rounded to 1290 and 1275 for more round numbers, but such minor adjustments are not needed, especially as subsequent price action saw real bodies and wicks of key upswing points form at these levels. Also, the current close under the lower boundary is done with steadily increasing volume and 3 black crows price action. Like with all key support ranges, a long-term drop is more likely if the next few candles continue trading under 1273 and preferably under today's close as well. As with the break of all key supports, it is natural to see a minor retracement back up to recontact the area which now offers crucial resistance. That is helped by the approximate area where the recent downtrend lines intersect. On the bullish side, there is a less common sustainment of green volume and price action that actually leads to GE keeping contact with the 1289 to 1273 range and trend line intersections into late September. Now it is crucial, even for medium to long-term perspectives, to observe how short-term bullish sentiment performs at a firm resistance range. In this case, a short-term bearish continuation reaffirms the larger downtrend and highlights the importance of waiting for short-term developments to decisively conclude. Due to a significant bearish spike in September, price action did not see a bullish recovery. This easily countered the minor uptrend developing from mid-August. Price action is mostly contained within the relatively horizontal resting phase range during the bearish continuations from June to September. They form a clear downward slope from the failed inverse head and shoulders. Just like a failed double or triple bottom, the failed inverse head and shoulders leads to the increased chances of neutral to bearish price action, especially when found in a multi-year downtrend, like with this example. Interestingly, a small head and shoulders forms into October as GE recovers in the short term to recontact the 13 range. Upon its completion, the old downtrend lines intersect nicely to define the clear declined neckline. These, along with a newer downtrend line from the head and right shoulder downswings, are helpful guides as an inclined double bottom transitions the chart into the new year with a sizable bullish reversal. Similar to the inverse head and shoulders, there is some flatter price action prior to the start of the double bottom. At the end of 2018, as would be expected, there is major resistance remaining at the 1289 to 1273 range, since it was the site of so much bearish activity. Lastly, this is a great example where a smaller pattern, like the head and shoulders, makes a proportionally big move due to the long-term context that is bearish in this chart example.